actually started investing at the age of about 7 years old. My dad also was a very passionate investor, and he allowed me to pick one stock per month, and he would buy me a share of any company I wanted. And at the time, they would mail you stock certificates, and he hung it on the wall of my room. So when I grew up, my room was literally wallpapered in stock certificates. And it was a great way to learn about investing because I really felt the power of my ownership. I had a stock certificate on the wall of my room, and I felt like an owner of a company, not somebody that was gambling in the stock market. But, I felt like I actually owned these businesses. So as a young child, I can remember going to the local Walmart with my father, and I had to go to the restroom. And I came out, and I told my father that the restroom was very dirty. And he said to me, "Well, you're an owner. What are you going to do about it?" And so I wrote to Sam Walton, who was the CEO of Walmart at the time, and told him that I was very disappointed with the experience and that he should have somebody clean the restrooms. And Sam Walton wrote me back, and he thanked me for my letter and assured me that he would take care of the problem. I'm giving you this story to illustrate that that is the lens that I view the investing world through. I don't view the stock market as a casino or a place to gamble with money. I look at it as a market and a place where I can buy small portions of businesses. So I've spent my life learning how to value businesses and how to pick profitable businesses.
Hi, this is Cayden from VIA Value Investing Academy. So happy New Year to all of you. For this YouTube Live tonight, this is the very first YouTube Live for me in 2023 because I'm supposed to appear in a YouTube Live on the 3rd of January, but I felt really sick. And first time in my life that I felt sick for 10 days. So it's really a 10 long days. So I think fortunately it's nothing really serious, right? So right now I'm back on my feet. So to me, this is my first YouTube Live for 2023, so I'm really back to be here healthy, okay? So just now you will have watched a video that's spoken by one of my favorite value investor. Her name is called Lauren Templeton. So I met her way back in 2018 where I organized a very huge event, I think about an event that's well attended by 700 plus packs from the beginning, like 9 a.m. all the way to 6 p.m. So she was the keynote speaker. And then she was in Singapore for about 5 days, a couple of days of events, and then I got a chance to spend, sort of like one-to-one personal time with her. So I really like her as a person. I also like her as an investor because the way she look at businesses, the way she look at stocks, yeah, and it's very similar to Warren Buffett, very similar to all value investors because they see behind every stock, right, there is a business. And so just now she shared a story about while she was a little kid and how her father taught her how to see stock as a business. So this is a very important concept because today we are going to talk about a dividends making businesses. Yeah, so here we go. So I'm going to put up my slide right now. Yeah. Now, by the way, if you're able to hear me, right, and see my slide right now, is it okay? Just type 1 so that I know that you can see. Okay, I'm going to put it full screen first, right? Yeah, full screen first. Yeah, so right now it's full screen. Okay, good. Now, if you don't mind, can you just type the chat whether are you able to hear my voice and see the slide right now? If you can, is it okay just type 1 so that I know that you can. Okay, good. Yeah, so Susie is here. Angeline never left. She's always on our YouTube Live. Okay, thank you. So we're going to start right now. Thanks. Now, by the way, this is my first slide, official slide, which is a happy Chinese New Year. This year, right, is actually the year of the rabbit. Yeah, year of the rabbit. So hopefully that everybody will hop all the way, all the way to the top. Yeah. Okay, so let's get started. But before we actually go into the content proper, there is a small piece of gift, right? Chinese New Year gift that I want to give you. Now, I'm not very sure whether you know, but anyway, I published a book about 2 years ago. The title of this book is called Value Investing Simplified, and the foreword that is written by Laura Templeton, the lady that spoke just now, right, via a video. And I'm giving away, right, a free copy of this book. Yeah, a free copy of this book. Huh? So if you want to get a copy of this book later on, right, you just need to go to www. You have to put this www, right, .valueinvestingsimplifiedbook.com. Maybe I just let my colleague help me to do this, right? So remember, you have to put the www, because previously I forgot to put www and the link didn't work. Yeah, so it has to be www. Huh? Yeah, so www, okay? Value Investing Simplified book. Yeah, book. We got Value Investing Simplified. You know, this domain name has been taken by other people. So www.valueinvestingsimplifiedbook.com. Now, so once later on, once you click on this link, a page pop out. You just need to key in the relevant information. Yeah, and you will get a physical copy, yeah, of the book, right, at no cost. Oh, but you just need to pay for the shipping cost. Yeah, www.valueinvestingsimplifiedbook. Okay, so the link is in the chat. Okay, so this is a small little Chinese New Year gift that I want to pass it to you. And if you want to learn more about value investing in a very factual and rational way, right, not hype or get rich quick, yeah, please feel free to visit our YouTube channel, youtube.com/valueinvestingacademy. So yay, right now I just showed this screenshot. We have 12.9K of subscribers. And initially, I think we started with about 3K, 3,000. So it's increased, I think, 4 times. 4 times, right? Like our stock increased 4 times. So special thanks to Susie, Irfan, and the team who has made this possible. Yay! So you don't really see them. Okay, so let's get started, right? So, today's topic is about dividends paying stock. Dividend paying stock. So you can see this slide. Should you invest in US or SG dividend stocks? Now, but before we go into the actual dividend stocks and so on, I think better, talk about the disclaimer, right? So as usual, remember, whatever companies that we share today, the knowledge, remember, is solely to illustrate the application of value investing methodology, because I am a value investor and we are Value Investing Academy. And of course, various valuation methods in the context of real life companies. So remember, under no circumstances does any of the information shared tonight represent any form of recommendation to buy, sell, or hold any stocks. And because we do not know you individually, right? So we do not take into account your individual characteristic profile or risk appetite of any given investor. So remember, in no event shall VIA or me and Hillary, who are the presenters for this evening, be liable to any one of you for any damages of any kind. So remember, neither My Kinesis Investments Private Limited or VIA, nor the authors are operated or affiliated with any broker, dealer, or licensed financial advisor. Okay, good. So let's get started, right? So since tonight we're talking about dividend-paying companies or dividend stocks, I think it's important for us to first understand certain terminology. Yeah. So what is a dividend stock? So before we talk about dividend stock, remember, right, the very first video you have watched, Miss Laura Templeton was saying when she was a little kid, the father allows her to buy stocks, right? Yeah, and in the early days during her generation, during our generation, when we were a little kid, you buy stock, right? They actually give you a hard copy certificate. It's called a stock certificate. Yeah. So in other words, if you want to buy McDonald's stock in the early days, before all the electronic broker and so on, right? Yeah. When you buy a stock, you are entitled to a stock certificate. A stock certificate. And of course, some people, they say, oh, I'm buying shares. Yeah, that's why you call it a shareholder. Now, when you say shareholder, that means we are holding on to the shares of the company. So what does it mean, right? It simply means that if we buy McDonald's share or McDonald's stock, we are owning a piece of the business, which means that behind every stock or share, there is a business. So investing is not buying a stock and then boast about, oh, today you buy a stock and then suddenly the share price go up by 5%, 10%, and so on. Yeah, so that's not investing, because in the short run, the share price can either go up, come down, or stay sideways. So that is not investing. So if you sit down, talk to your friends, and then the friends keep talking about price and nothing about the value or performance of the company, I don't think they're investors. They could be traders or speculators. Yep. So remember, our job here is to protect you. So it's very important for us to define what is investing. So one more time, investing is buying a portion of the business by buying its shares or stocks. Yep. So that if the company do well, they will pay you in some form. So what kind of income, right, do they pay you? So let me illustrate this. The first income that a business will pay you is in the form of capital appreciation. Appreciation means going up. Yeah, which means that, for example, you buy a company at 10, it goes up to 20, it's called capital appreciation. Now, there is only one reason why share price go up, and there is no other reason. Yeah, so the only reason the share price go up is the company it has become more and more profitable. Yeah, profitable, huh? And when I say profitable, right, there are many metrics. It could be earnings per share. It could be profits, or sometimes people call earnings. But it's very dangerous to buy a stock that is not profitable, but the revenue is going up. So for an example of company that's not profitable, but the revenue is going up, examples include Grab. So revenue is going up, but they're still losing money. Another company is called C Limited. C Limited, remember Shopee, right? Shopee, huh? So C Limited, yes, the revenue is in fact exponentially going up, but the profit is exponentially going down. Yeah, so it's all negative. Yeah, so these are very dangerous. These are dangerous, right? So remember, there's only one reason that share price go up is the company is becoming more and more profitable over time. Over time, but in between, share price are very much influenced by the behavior of gamblers. So in other words, when gamblers hear bad news, they will sell. Yeah, when the gamblers hear good news, they will buy. So in the short term, it's highly erratic, and nobody can predict the share price in the short term. But more people like Warren Buffett, they do know that 10, 20 years down the road, if they invest in a good business, the share price only has one direction, which is up. And share price will only go up provided company is becoming more and more profitable. So that comes from the form, right, of capital appreciation, long term. It may take 1 year, 2 years, 3 years, 4 years, 5 years. Now, so since you're owning a piece of a good business that's profitable, that makes money, right, and you are the shareholder, the second benefit that you will get in terms of income, right, are dividends. Now, remember, if the company does not make money, they got nothing to give you, right? Which also means that if, let's say, I lose my job, I got no money, then I don't have any money to give it to my children as pocket money because there's nothing for me to give. So remember, right, only profitable company pays dividends. How much is it? We'll talk about it later. So capital appreciation, sometimes called capital gain, first source of income. Second one is dividend. So long-term, mid-term. Then for the third category, I think it's more specific for our graduates. CFOS stands for cash flow options strategies. So for those people who are grad, you know that we use this strategy predominantly to sell two type of options, either put option or call option. So we are option writers, and because we sell lottery tickets, we collect the income. We are not lottery ticket buyers. We are not option traders or option investors, so we don't. Yeah, so because we sell options, we collect the premium instantaneously on the very night. Yep. So in other words, for us who are VIA graduates, we will generate not one, not two, but 3 sources of income as long as we are able to identify a good business at a cheap price via value investing. Yeah. So since we're talking about dividend paying stocks, I need to first explain what are companies pay dividend and what are companies don't. Yeah. So predominantly, right, there are 6 types of company. Yeah, but to make life easy, we'll just identify 3 types of companies. Now, the first type of companies are fast growth companies. In other words, the revenue go up very fast, and then sometimes the profit go up very fast. So I'm going to use Tesla as an example. Yeah. So Tesla in the early days, maybe 3-4 years ago, the company wasn't profitable, but the revenue was going really high. I think as investors, you should be glad that for the past, I think 2 or 3 years, Tesla has been making money. Yeah, has been making money, but previously it wasn't. But because Tesla is still growing, and to grow, they need money. Yeah, which is why as of today, even though Tesla is profitable, they are not giving out any dividends. Yeah, because they are fast growth company and they need money to grow. So in other words, if you are exploring fast growth company, you need to accept that they don't pay dividends. Sometimes no, or sometimes very little. But to compensate that, right, because they are fast growth, yeah, your share price of the company may go up very fast because their profit will go up very fast. Yeah, so this is these are the characteristics of a fast growth company. Yeah. So let's look at the other extreme, which are slow growth. Sometimes I will hear seniors calling slow company blue chip companies or large capitalization company. So when we talk about slow growth company, because they are slow, yeah, the capital appreciation is very slow, right? Grow very slow because they're huge, they're giant, right? And because they are very huge, they are usually very established companies such as Coke. Yeah, very established company. Yeah, they have huge amount of cash, so they can pay you higher or stable dividends as compared to company like Tesla. So remember, right, here we are not placing a judgment of whether Tesla is better or Coca-Cola is better. Yeah, so what I'm trying to say is there are two extreme end of companies which are fast growth and slow growth. And it all depends on what you like, you see. Okay, and what makes sense to you. Then, of course, if the two extreme is fast, slow, there is one right in the middle, right, which is like medium growth company. So DBS, fortunately, is still growing, even though it's a blue chip company. And they, of course, in terms of giving back the return on investors, they do have some capital appreciation, provided you buy at an undervalued price, and they do pay out, I would think, not bad sort of dividends. Yeah. So these are three types of company. So today, what we're going to talk about is predominantly we are going to talk about dividend-paying companies, which are either medium or slow. Yeah. But before I continue, I just want to let you know, right, that how do you know, like, which company ABC, which one pays better dividend? Yeah, dividend, huh? So it's important for us to understand some terminology. But before I share with you some terminology, I just want to boost my ego by showing you this picture, right? Now, you just to let you know that the context of this picture, right, is that I'm sitting in a park. It's actually a Troy. Have you watched this movie called Troy, where there's a like Trojan horse, right? They try to attack a castle, and then the soldiers are hidden in the Trojan horse, and then eventually they jump inside the castle and so on. So the mock-up Trojan horse is actually shown here. Unfortunately, it's blocked by this tree. Don't know why. It's shown here, right? Yeah, so I went to this Troy Park. Actually, it's in Turkey, and it's winter, which is why if you look at the trees, there aren't any leaves. Yeah, so this photo, the context is I'm in the Troy Park during winter. Just a month ago, I was sitting there, right? And this cup of coffee here is actually called Turkish coffee. Yeah, and the reason why I show you this, what's it got to do with dividend-paying stock, right? You see, the key thing is at the end of the day, we use our hard-earned money to invest. Yeah, so we want income. And assuming there's a steady stream of income, whether it's dividend, capital gain, or standard options, you just want to buy back some time. You just want to chill, you don't want to work, and so on. So I just want to share with you how powerful dividend companies are, or dividend-paying companies are. Now, and I'm going to use a US company as an example. Now, for Singapore company, usually they pay, if they pay dividends, usually it's about once per year or twice per year. Yeah. For US companies or companies that are listed in US, if they do pay dividend, usually they pay 4 times per year, which means that if I own one US company, yeah, so 1 year I'll be paid 4 times, right? And remember, because I'm a shareholder, yeah, I don't work for the business work for me, which is why they pay me, because I work for the business. And then if it's 10 companies, you get paid 40 times per year, right? And if I take 365 days divided by 40, every 9 days I get paid, right? For not working. Now imagine every 9 days you hear this sound, ka-ching, 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 right? For the next 50 years of your life. That's a lot of money. But if your portfolio size is huge, like for example, 20 companies, what does it mean? 20 companies, you get paid 80 times per year. And if I take 365 divided by 80 times, 4.5 days you get paid. So in other words, I think every 3 weeks, every 2 weeks you get paid like 3 times. So that's a lot of money. So am I right to say that if we have 20 companies, we get paid every 4.5 days, we can every day drink Turkish coffee, every day can travel? But of course, the reality is to have 20 companies, you need to have 10. You need to have 10, right? To have 10 companies, you need to have 1. Yeah, in order to have 1, you need to attend this class, right? This YouTube like to know what investing is all about, what is dividend-paying companies are. Yeah, so at this point, the midpoint summary is to let you know that US company pay 4 times. The more companies you have, the more times you get paid throughout the 365 days. Yeah, so what is a dividend-paying company then? Now remember, right? Yeah, dividends are being paid from a company's profit, which means that only when a company is profitable, they pay dividend. The more profitable they are, the more dividends that they can pay to the shareholders. Very quick intro. Another one is, remember just now I said, for US company, they pay regular distribution in the sense that for US company, they pay 4 times. Yeah, for Singapore companies, sometimes they pay only annually or semi-annually. Yeah, and do know that a dividend payment is voluntary, which means that it's the company's management decision to decide whether to pay or don't pay. So if Tesla don't pay, which means that Elon Musk plus the board of directors have decided not to pay shareholders dividend, and they are not obligated to pay you, which means that before you buy the business, you better ask yourself, if the company do not pay dividend, is it something that you're okay with? So you cannot buy already and then try to blame the company, right? Because remember, paying dividends is not an obligation. It's not mandatory that they'll pay you. Okay, so very quick intro, right? Yeah. So when people talk about paying dividends, we have to understand two important terminology. Yeah. So for example, if I buy a stock, buy a business, and then I say, oh, this company pays high dividend. I mean, what does it mean? What do you mean by high dividend? So we need to understand that there are two important terminology. The first terminology is called dividend yield. So what is dividend yield? So this is the formula. And I'm going to go a bit slow, right? So whenever come to math, it gets a bit more difficult. So you can see, right? Dividend yield is equals to the annual dividends per share. Now these terms are a bit misleading, right? Which means that how much the company has paid dividends for the entire year. For the entire year, not just a quarter, but the entire year. So that's the numerator, right? Divided by the current share price, then multiply by 100%. Yeah. So let me give you some specific example. So let's say the current share price is 10. So this one belongs to the denominator, right? Then the company pays $1 of dividend, which is the numerator, right? So what does it mean? So it's 1 divided by 10 times 100, right? Yeah. So 1 divided by 10 times 100 is 10%. So the dividend yield is 10%. So when people say high dividend, low dividend, usually they are referring to dividend yield. Yeah, dividend yield. Yeah. So I'm going to give you a number, right, which is the average dividend yield of a US listed company or SG listed company. So usually the average dividend yield is about 3%, which also means that if the dividend yield of a company is more than 3, such as 5, 6, 7, usually for REITs, yeah, it's considered high, on the high side. If it's below 3, it's on the low side. If it's about 2.5, it's on average. So remember, the benchmark is about 3. Yeah, but having that in mind, you cannot say that if a company's dividend yield is 5%, oh, it's good. It's good. Why? Because if you look at the formula carefully, sometimes the dividend yield may shoot up because the share price fall for whatever reason. So if the share price fall, yeah, the denominator become very small, obviously the dividend yield will go up. So when you see something such as a high dividend yield, don't quickly jump in and buy first. You have to understand, yeah, when the dividend yield goes up, is it because they pay more dividend, or because the share price has dropped, or because it's both? Okay, so be very careful. So use 3% as a benchmark. So the moment it's very high, you have to pay attention. Is it a numerator or denominator? So that is dividend yield. Now, and if you look at the numerator again, yeah, this will lead to the second term, right, called dividends per share. So be very careful when some people say paying dividend. You have to ask them, do you mean dividend yield, or do you mean that if I buy one share of a company, how much dividends the company is paying me? Yeah. So dividend per share, as the formula implies, that means if you buy one share of the company, how much does the company pay you if you own one share? Yeah, very simple. Very simple. So I'm going to use an example, right? Yeah. Now, this slide over here shows the dividends payout for this company called DBS. Everybody know. Okay. There are a few terms that you need to look. So in other words, if you come to this page, the first thing you have to ask yourself, dividend yield, 4.13%. 4.13% is above 3%, right? Yeah, so it's above average. And it's understandable because DBS is a stable company, it's a blue chip stock. You expect this company to pay you slightly more. Yeah, so seniors like to buy this company. Yeah, so this is the first piece of information that you want to see. Yeah, 4.13, not bad. But remember, right? Yeah, you have to ask yourself, hey, the dividend here is 4.13. Is it because the share price is on the lower side? Or the share price is more or less stable, but the company is paying more and more dividends? Yeah, so now the next question is, okay, dividend yield is slightly above average. So how do we know, is it attributed to the increasing dividend payout? So the second thing, you just need to look at this side. Can you see here? This here, right? Now, what does this series of number means? So I'm just going to pick one number over here. Yeah. So on the 24th of November, can you see this payable date? Payable date. So on the 24th November, DBS actually payable date, pay out 36 cents, right? Now this one is for one share. One share, that means if you own one share of DBS, you receive 36 cents. Yeah, but usually for Singapore stocks, you buy in multiples of 100, which is called one lot. Yeah, so you will have 100 shares. If it's 100 shares, obviously it's this times 100. Then you have Sing dollars, $36. Not bad for doing nothing, right? You can have maybe 5 or 6 packs of nasi lemak for free. Okay, huh? So first thing, you look at the dividend yield. Second thing, right, you look at the dividends paid out per share, which is this per share, huh? Second thing, right? And the second piece of information under this dividend per share is you look at the trend. Yeah, overall is the trend increasing. Now from here, right, yeah, it seems that the trend is increasing. Initially 0.18, then after that 0.33, and after that 0.36. Now I am not sure what's happening here. What's happening here, right? Why there is a decline? Oh, yeah, I still remember there was 1 year. Oh, now I know why. Now there was 1 year that MAS, which is Monetary Authority of Singapore, decided to cap the dividends per share payout by the 3 local banks. I suspect this is one of the reasons why the dividend payout seems to be quite small. Yeah, then after that, you see when the government announced this, the company is still making money, what? But the interesting thing is the share price fall. So during a period of time, if you bought some of the 3 local banks, whether it's OCBC, DBS, UOB, right, and then the MAS say, oh, there is no cap anymore, the share price will have gone up. Yeah, so this is one of the reasons. I think that took place in 2020. Yeah, somebody, maybe you are free, if you're watching this, you can go and check. Yeah, so just disregard this because this one is imposed by MAS. So right now, you know dividend yield, yet you know the dividends payout per share, which is absolute amount, right? Now, so the next thing we need to understand is if you're investing in companies listed in Singapore, if you're investing in companies listed in US, so what's the difference? Yeah, so if you look at this table, right, just to let you know that tax are important. Yeah, I don't think you want to pay high tax, right? Yeah, so if you sit down having lunch with a friend and if your topic is about tax, your income must be very, very high. Because only people with a taxable income of, I think, 300,000, worry about tax. Because that's about, I think, 22%. Yeah, but Singaporean, I don't think they talk about tax. Okay, I talk about tax, right? Yeah, so if you buy companies listed in Singapore, you buy companies listed in US, and then you buy low, sell high, right? Capital gain is non-taxable, which is white cross, non-taxable. Dividends for Singapore listed company, non-taxable. For US, there's a 30% withholding tax. So what does it mean? It simply means that if you own a US listed company, and this US listed company is supposed to pay you $100. Yeah, you know the government, right, the broker, right, will auto minus 30, which means that if you look inside your brokerage account, you will only see $70 because $30 has been removed, and there's nothing you can do about it. Okay, huh? So for Singapore listed companies, there is no option such as option premium because we do not have an option exchange. Then for US, right, again, it's non-taxable. So what does it mean when I show this? What does it mean, right? In other words, if you are personally very passionate about Singapore companies and you like dividend-paying Singapore companies, then you want to focus on companies that are listed in the Singapore Stock Exchange. Yeah, because it's non-taxable. You see, here non-taxable, right? Yeah, for me, 90% of my portfolio are companies listed in US. The reason why is because I want to focus on growth. I wanted more capital gain. I do not mind have a lesser dividend. Yeah. So then I also like this option premium, in which I can collect tens of thousands of dollars every year, right? Yeah. So for me, I focus on US company. My counterpart Liu Feng, right, who's a Singapore stock guru, he focuses on Singapore companies. Yeah. So Angeline told say 2021 restriction lifted, which is true. So which means that if I come back to here, right, 2021 is here. So can you see when it's lifted, the dividend, right, went from 0.18, right, to 0.33. Yeah, and if you check the share price, I think the share price will have gone up. Okay, so thanks, Angeline, right? Yeah. So now the only question is you have understood the term called dividend yield, where 3% is the average. Yeah, and you know that you want to know how many times the company pay you. You also want to observe, right, whether over time are the dividends stable and increasing. And in this case for DBS, yeah, it's stable and it's increasing. Yeah, if we disregard the MAS so-called a restriction. Yeah, restriction, huh? So now the only question that's left is, hey, I want to be paid dividends. So when should I buy the stock? Now, assuming that the stock is undervalued and you own the piece of the business via buying stocks. Now, one important term you need to note, right, is this date called ex-dividend date. Ex-dividend date. So what does it mean, right? Yeah, in order for you to be legally entitled to the dividend, you as an investor, right, must purchase the stock at least 1 day before the ex-dividend date. Which means that if the ex-dividend date is on a Wednesday, you must buy on a Tuesday because it's at least 1 day before, right? So you must buy Tuesday or earlier. Okay, so this is a buying rule in order to be entitled to the dividend, right? So the second one, right, if the investor were to sell the stock on the ex-dividend date itself or afterwards, which means that if you sell on a Wednesday or later, right, you are still entitled to have the dividends. So if that's the case, some investor were saying, hey, then actually no need to learn investing, you just need to take a piece of paper, write down all the ex-dividend date, and then just wait, and then the day before just go in and buy, don't need to calculate what intrinsic value, so troublesome, no need to take Cayden's cost. And then the next day just sell. Now, by the way, if it's so easy, right, everybody will be rich. Everybody no need to go to school. I'll ask my children to quit school and just buy 1 day before ex-dividend date. But it doesn't work that way, you see. It doesn't work that way is because when a company want to, want to give out dividend, right, they will make a declaration. They will declare, they will say, hey, I'm going to pay dividend. And the moment they say, I'm going to pay dividend, I'm going to give you money, right, give a guess. What will gamblers behave? Gamblers will quickly jump in, right? And then buy. So in other words, the price of a stock usually will creep up until the ex-dividend date. And everybody knows that next day can sell, right? So you realize the next day, suddenly the price dropped. Which means that the gap over here, the so-called the paper loss, right, will be larger than the dividends that you're going to collect. Which means that if you play this game of just buying on 1 day before ex-dividend and selling, most likely you will lose money because of the drop in share price. So don't do this, Don't do this, right? So right now, you know dividend yield, you know the dividends per share, you know when you need to buy, which is 1 day before ex-dividend date. So of course, there are some things you need to take note before I hand over to Hillary, right? Now remember, there are two major misconceptions about dividend-paying companies. So sometimes I hear my friends say, you don't want to buy companies, right? Very easy. You just need to look for high dividend yield. For example, REITs, dividend yield is 9%. What's that to think, right? 9% is so high. But you have to understand that dividends are being paid from the company's profit. If the company is not so profitable and they pay you dividend, it's quite a dangerous act. And if the dividend is too high, sometimes it also implies that the money may not be investing in the business. And because the money is not reinvested, the growth in terms of capital gain will be quite slow. Quite slow. So in other words, right, you cannot use high dividend yield as a criteria for you to gauge whether a company is good or bad. So that's one. Number two, right, the second misconception is, remember, dividend stock is always safe. Whoa, this is a very dangerous word. Now, when a company pays dividend, remember, theoretically, the dividends has to come from the profit. But what if the company is not profitable? That means losing money. And then they pay dividend. Isn't that quite dangerous? Because the money has to come from somewhere and the company is not making money. Where do they find money to give you dividend, right? Now, the moment the company is losing money and they pay you dividends, it's a red flag. I think you better run as fast as possible away from this company because the company may be using debt. They may be borrowing money and use the borrowed money to pay you dividend. And this is not sustainable because if the company is not profitable over time, there will be one point of time where the management will have to decide that I'm not going to pay dividend. But because the price has already been propped up, right? And then, I'm not going to pay dividend. Give a guess, what will happen to the price? The price will collapse. And if the price collapses, even if you have collected 3%, 4%, it's no use because the company share price may collapse by 30%. So last point, right? If profit plunge and they cannot sustain this, eventually they have to cut or stop the dividend yield. That's when the share price will collapse. So in summary, right, do not just buy stocks because the stock pays dividend or pay high dividend. Okay, So now, of course, today, right, we want to talk about something nicer. About dividend-paying companies. So in the next maybe couple, 20 or 30 minutes, my colleague, right, Hillary, she's right now stationed in Malaysia, right? She's going to talk about companies that pays dividends. Okay, and what are these companies? So right now, I'm going to stop right here, and I'm going to hand over to Hillary.
So let's jump right in. So for this week, we are looking at this website for US stocks, which is Share Dividend. So while I was doing the research, I realized that there are two types of dividend stocks for US stocks, which is dividend aristocrats and also dividend kings. So what are the difference between these two dividend for the US stocks? So now let's first look at dividend aristocrats. So for dividend aristocrats, we are looking at 4 criteria for a company in order to qualify as a dividend aristocrat. First thing is that they have to be within the S&P 500 index. And then they are paid and raised the dividend payments for consecutive 25 years. That means for 25 years, they have to pay consistent dividend without missing a dividend payment or maybe a drop in the dividend payment in order to qualify as a dividend aristocrats. And they also have a size limitations, which is the company has to have a minimum cap of 3 billion in terms of the company size. And they also have a liquidity, which means that on average, there's about 5 million in daily share trading value for the past 3 months. If a company qualifies all of these 4 criteria, it is considered as a dividend aristocrats. So as of 30th December 2022, there are a total of 64 dividend aristocrats. Okay, so now why should one consider to invest in dividend aristocrats? It's because it is a reliable source of income where there's increment dividend payments year over year. And also, most of them are industry leaders with reliable cash flow and also impressive annual returns. And also, they are much more stable where there's lower volatility compared to growth stocks such as Sea Limited, Grab, or Tesla. Okay, so right now, let's look at their past historical performance. So we can see that since 2012 until before the pandemic, dividend aristocrats has been performing much better than S&P 500. However, in the latest results, the historical performance after the pandemic, we noticed that S&P 500 actually overtook the dividend aristocrats. So why is this so? Because if we look at the sector breakdown, here this sector it is for the dividend aristocrats. We will notice that most of the companies are coming from consumer staples and also industrials, which are well known for being safe and stable companies. Most of them are considered much more lower growth. But for S&P 500, we will see that a quarter of the overall sectors actually comes from information technology, which are companies such as Apple, Microsoft, and also HP. So these companies are considered quite fast growth compared to consumer staples such as food industries. So which is the reason why during the pandemic, the S&P 500 actually overtook the dividend aristocrats. But since 2022, where there's a recession, bear market, we see that actually the S&P 500 is performing on par with the dividend aristocrats. So this is the overall historical performance for dividend aristocrats for the past 10 years. And for these dividend aristocrats, they also have an ETF, which is known as Dividend Aristocrats ETF, NOBL. So for this dividend aristocrats ETF, we'll see that this is the only ETF that tracks of the S&P 500 dividend aristocrats performance. And they have quarterly distributions of the dividends. So the dividend yield is about 2.69, which is on average of the 3% that Cayden has mentioned earlier. And for every ETFs, you have to take note of the expense ratio, which is the amount has to pay when you purchase the ETFs. Okay, so for example, if you invest in this ETF in 2013 for about $10,000, so after 10 years later, it will rise about 178%, which is about 27,000, or we round up as $28,000 if you invested in ETF for the past 10 years. And currently for this ETF, they are having 64 holdings, which is the 64 companies within the dividend aristocrats. So here are the top 10 fund companies for these ETFs. And this is the fund sector. So we can see that the sectors are quite similar to the sector that was being shown earlier, where consumer staples and industrials are the top 2 sectors in these dividend ETFs. So when we talk about ETFs, earlier on, Cayden has shared that if you purchase a US stocks and they pay dividend, there will be a 30% withholding tax. So now let's look at the example. So if you purchase a US stock and they pay out dividend, there will be a 30% withholding tax. So that means that there's a 30% loss for Singapore investors because there's no tax treaty between US and also Singapore. And if you purchase a US ETF, there's also another 30% dividend being charged on to the Singapore investors. So here is an illustration, example that I got it from Practice Finance. So you can see that Apple pay $100 of dividends, but before the $100 reaches to a Singapore investor's account, there will be a $30 of withholding tax, as you can see, as being deducted from here. And in the end, the Singapore investors only received $70 of dividend. So this is what it means as withholding tax. So there's nothing we can do about it, as Cayden said, because it's already been deducted from our account. Okay, so now when I was doing the research, I found out there's another way we can purchase an ETF, but not for US stocks. It's only for ETFs. So one can consider to purchase an Ireland domiciled ETF, but for this one, it's just an introductory. So for example, if we purchase US stocks or US domiciled ETFs via an Ireland domiciled ETF, like for example, there's a 15% withholding tax being charged onto these Ireland ETFs. But if Singapore investors purchase an Ireland ETF, there's no withholding tax. So in a way, it means that there's only a 15% dividend loss for Singapore investors. So we see here, for example, there's a tax treaty between US and Ireland, so that's why there's a 50% tax. So if, let's say, for example, Apple paid $100 of dividend and a person purchased an Irish ETF funds, there's a 50% tax withholding, so they will get paid $85. But definitely there are some fees and expenses because for ETFs, it's being managed by fund managers, so there'll be fees and expenses. So we assume that there's a 75 dividends being paid from the fund, and there's no tax between an Ireland and Singapore. So which is why, as a Singapore investors, they will receive $75 of dividends. So compared to the earlier example, at least we are not losing out 30% of the tax. 30% of the tax. It's only 15% if Singapore investors purchase via an Irish fund. So this is how it actually works if someone decided to purchase an Ireland ETF. Okay, so right now let's look at some examples of the dividend aristocrats. So for today, we'll look at Essex Property Trust, which is a real estate investment trust in the US, and they are mainly focused on apartment communities in the west coast of US, which is in Southern California, Northern California, and also Seattle. So this is how the company actually manage the apartments in these areas. So it is one of the 10 largest owners and also 20th largest apartment property manager in the US. And the revenue are mainly generated from rental and also management fees. So someone might be considering what is the difference between REITs and also purchasing a house and earning rental income. So for REITs, it is actually a company that owns, operates, and also finance income-generating real estate. So in the US, there are 3 subcategories, which is equity. So for equity, it means the company actually owns and also operates income-producing real estate, as if they are the landlords of those buildings, of those real estates. And for mortgages, they are actually companies that provide financing for the real estate to purchase these buildings, and they will earn the fixed income from the interest of that financing. And there's also another type, which is hybrid. That means a combination between equity and also mortgage. So these are the 3 subcategories for the US REITs. Okay, so right now, let's have a quick look at how does the REIT actually works. So as investors, they will invest their money with REITs, and REITs will be using this money to purchase and manage the real estate, which is examples of these buildings. And when they manage these buildings, they will earn some rental income. So here, when they earn the rental income, they will take back 90% of the profits are given back to the investors. So this is how REITs actually works when compared to purchasing a building and earning a rental income. Okay, so right now, we'll look at some of the dividend metrics. So earlier on, Cayden has shared 2 of the dividend metrics, which is the dividend yield at 3.91, and we can see that it's a slowly gentle uptrend. And for dividend per share, it's also an increasing uptrend. But then there are also some people look at another dividend metrics, which is dividend payout ratio. So before we go in further, let's understand what is the dividend payout ratio. So here, dividend payout ratio, this is the mathematical formula for dividend payout ratio. So in short, it means that the percentage of the company's earnings is being distributed to shareholders. As you can see that here, how much dividends that a shareholder will be getting, it depends on how much of the earnings was being distributed by the company. So here is an illustration of the diagram. So assuming that the company has an earnings or net income of 20,000, and a portion of it the company will keep back to grow the company, known as retained earnings. And $5,000 is being given out to all shareholders. So in short, if we plug in the numbers into the mathematical formula, we'll see that there's actually a 25% of dividend payout ratio. So that means that 75% the company keep back in order to grow the company, and they will give up 25% as dividend to all shareholders. But even though it's 25%, this number does not mean anything. So we will look at the trend of the dividend payout ratio. So let's jump back right into the chart. Okay, so right now we see that dividend yield is increasing, dividend per share is also increasing, which is something that shareholders like to see because they are earning more money. But then we see that the dividend payout ratio is on a gentle downtrend. So investors might be concerned that, does this mean that I'm getting lesser dividend? But if you remember the chart earlier, a portion is given out as dividend, but another portion retained earnings, the company keep back to grow the company. So in order for the company to grow, they will need to have money to grow. So when the company is growing bigger, then they will earn more revenue and generate more earnings. So if they have more earnings, then they can pay out more dividend. So when the payout ratio is on the gentle downtrend, it's not necessarily a bad thing because it means that the company is using back the money to grow the company. So this is what this chart actually means. Okay, so now when we are purchasing or we are considering to invest in a dividend company, we need to understand that we not only look at their dividend payment, but also understand the company as a whole. So we will look at their financial metrics. So the first one is definitely we look at the revenue, which is the sales generated by the company. So for this, we wanted to see a positive and also consistent uptrend. And for earnings per share, which is the profit that the company generates for every share that the investors purchased. So for the trend, we wanted to see that it's positive and consistent uptrend. So for operating cash flow, it's the cash flow that is generated from normal business activities. So if the cash flow is positive, that means there's money coming in from the businesses. But if it's negative, the cash is actually bleeding from the business. So the trend we wanted to see is also a positive and consistent uptrend. And the debt to equity ratio is to let us know that how is the debt situation of the company. So here, based on this mathematical formula and also the value investing philosophy, we wanted to see that it's less than 0.5, which means that for every $100 of the equity, the company cannot borrow more than $50 of debt. If the debt is as if a hole in the pocket, if the hole in the pocket is very big, so no matter how much money the company can earn, the money will drop off from the hole. So this is what debt to equity roughly means. So now let's look at the financial metrics for assets. So for assets, we see that the revenue is increasing year on year, which is a good thing based on value investing methodology. And then next, we look at their earnings per share, which is also increasing year on year. And operating cash flow is also on a positive uptrend, but their debt to equity ratio is more than 0.5. So this is something that investors should take note and further investigate into the company to determine whether it is a good company for one to invest in, even though the dividend looks good. Okay, next, we will look into dividend kings. So for dividend kings, it's somewhat similar to dividend aristocrat, but they pay dividends on a consecutive manner for 50 years. So if, for example, if the company paid less or they did not pay dividend, then they might lose the status as a dividend king. And also, they are not necessary to be within the S&P 500 index, but they are commonly found in this sector, which is in consumer goods or consumer staples, industrial, healthcare, and utility. So we can see that these companies are actually stable, but has slightly slower growth compared to information technology companies, and also communication companies. Okay, so as of 26 July 2022, there are a total of 41 Dividend Kings company. And also, some Dividend Kings are also Dividend Aristocrats because they need to qualify as a Dividend Aristocrats before they can proceed on to become Dividend Kings. Okay, as this chart actually shows. Okay, so these are some examples of a Dividend King company where we can see that they actually paid consecutive dividends for more than 50 years. Okay, so one might consider that why should they invest in Dividend King? And also here, it is recommended to hold long term because they have a reliable income. They have a consistent being paying out the income for the past 50 years. And also the dividend yield is getting higher and higher because the payment is getting increasing. So as the saying goes that the longer you hold this Dividend Kings company, the greater wealth building chances are. However, one should take note that these companies, they have lower growth and some of them, they might perform below S&P 500 as we see earlier on the Dividend Aristocrat chart. It's because if we look at the sectors, we see that they are actually slightly slower growth compared to the fast growth company. And also, for Dividend Kings, they do not have any ETFs. But if you wanted to know the ETF, you can refer back to the Dividend Aristocrats. Okay, so now the company that we'll look at is actually Lowe's company. So it's a world's second largest home improvement retailer. And they sell products via omnichannel, means they sell their products via in-stores, online, or contact center calls, or their employees will go to the customer site to provide on-site consultations, as the diagram shown here. And they have about 1,971 retail stores as of January 2022. And these are the product lines being offered by the company. And they also offer services to their customers. Okay, so right now let's look at their dividend metrics. So the dividend metrics, which is the dividend yield, we can see that the trend is slightly on the gentle uptrend. And the dividend per share is also increasing year on year. So how about that dividend payout ratio? So even though in 2019 there was such a high pay, but we can see that on overall the trend is actually on a gentle downtrend. So which means that the company is actually reinvesting the money they earn while giving out dividend payments. Okay, so right now let's look at their financial metrics. So their revenue is increasing year on a positive uptrend. And the EPS is also increasing on an uptrend manner. The operating cash flow is also increasing. However, for their debt to equity ratio, we observe that since 2019, the debt has been increasing, which means that their long-term debt is also increasing. But then on 2022, the debt suddenly decreases down to zero. So this perked up our interest and we have to check on the annual report. And from the annual report, it was being shown that they actually buy back their shares and led to a negative retained earnings, which is the reason why the debt to equity ratio goes to zero. So this we will have to further investigate for their subsequent quarterly report or their next annual report in 2023 around January to see if the company is still doing fine. Okay, so now we'll look into Singapore Dividend Stock. So which website are we going to look for Singapore Dividend Stock? So actually, I'll look into this Smart Investor is because one of the reasons is their founders were former executives of Motley Fool Singapore, and also their title actually attracted my attention is because they paid uninterrupted dividends, just like the Dividend Aristocrats and also the Dividend Kings. So I'm curious that in Singapore, what stocks are paying uninterrupted dividends? So come on, let's find out. So first is the Singapore Exchange Limited. So it's a financial exchange and also clearing house. So what is a clearing house? So a clearing house, as you can see from the diagram, it is kind of like a middleman to ensure that the transaction between the buyer and the seller can proceed smoothly. So someone might be confused between an exchange and also a clearing house. So a clearing house is as if like a middleman to make sure that the transaction is smoothly being proceed. But an exchange is kind of like a marketplace where the buyer and the seller can meet up and do the exchange. But they do not have the clearinghouse as a middleman. So this is the difference between an exchange and also a clearinghouse. And SGX also provides subscription of market data and also connectivity to various exchanges. And these are the asset classes that is being offered over the SGX, which is all these 6 asset classes. And for Singapore Exchange Limited, I'm quite curious that how do they actually earn money. So when we look at their revenue breakdown, we'll see some of the short forms where FICC stands for fixed income and also currency and commodities. DCI is data, connectivity, and also indices businesses. And equity is the stocks that being traded via cash. And derivatives are actually financial contracts that involve futures, options. These are known as derivatives. Okay, so right now let's look at the dividend metrics for SGX. So the dividend yield, we observe that it's actually on a slightly downtrend, but the dividend per share is actually on an uptrend. So how about the dividend payout ratio? The dividend payout ratio is on a downtrend, which means that the company is actually reinvesting to grow the company. Okay, so right now let's look at their financial metrics. So the revenue is also on a positive uptrend, and the EPS is also on a positive uptrend, which is what we wish to see. And the operating cash flow overall is on a positive uptrend. Even though their debt to equity ratio is below 0.5, but we can see that since 2021, it has a high jump, and 2022 is almost reaching 0.5. So as investors, one should take note about this situation for SGX if they are interested about this company. Okay, so next, when we talk about Singapore dividends, we cannot miss out Singapore REITs. So for Singapore REITs, there are a total of 7 sectors, which is in commercial, retail, hospitality, and so on. So for today, from the article that was being shown, they actually shared about Parkway Life REIT. They also share different types of REITs, but this one is one of them that they shared. So Parkway Life REIT is one of Asia's largest listed healthcare facility and REITs. And they have a total portfolio size of 61 properties. And they are mainly focusing on hospital, medical centers, and also nursing home. So where are they operating at? So there are 3 hospitals in Singapore, 1 in KL, Malaysia, and 57 nursing homes in Japan. So this is the overall business that Parkway Life REITs has. And now let's look at their dividend metrics. So for the dividend yield for Parkway Life REITs, it has been decreasing since 2019, but the dividend per share has been increasing year on year. And how about the dividend payout ratio? For here, it's quite hard to see a trend because some years they have a high payout, but some years they have a very low payout, like the recent payout here in almost 2022. Okay, so right now let's look at their financial metrics. For their revenue is on a gentle uptrend, and the EPS, there was a sudden high shoot up in 2021. And the operating cash flow, even though there was a high shoot up in 2013, but we can see that the overall trend is on a gentle uptrend. And the debt to equity ratio is actually more than 0.5. But since 2018, we can see that it's slowly decreasing. So as investors, we should continue to monitor on the performance of the company. So as a conclusion for today's dividend stock, so what are the pros and cons that one investor should consider? First off, as dividend stocks, as it mentions, they provide regular income. And for dividend stock companies, they are usually blue chips company where they are much more stable or has lower volatility, especially during bear market. However, there are 30% withholding tax for Singapore investors if they purchase a US stock or US ETFs, and it has a lower growth and might not be suitable for capital gain, especially if investors are looking for high growth. So in addition to that, for US companies, they can consider to invest for capital appreciation, but they can take dividend as a bonus because of the 30% tax. And for Singapore stocks, if people are looking for regular income, they can consider to invest in Singapore's dividend stock, but there's a slightly slower capital appreciation compared to a growth stock. So with that, this is what we are able to present about dividend stock for today, and I hope that you have enjoyed the session, and I'll pass back to Cayden. Thank you, everyone.
So before we start, there are about maybe 101 people watching this video. Is it okay that you help us do a thumbs up? The Chinese New Year good luck, right? Chinese New Year good luck. Yeah, so that there is a thumbs up in our video. Maybe I give you a couple of seconds. If you don't mind, just help us do some thumbs up. Like for ego boosting. Okay, good. So we shall start. Now you should be able to see my slide right now, which was Hillary's last slide. And if you look at the slide right now, you know, she already said that investing in dividend-paying companies, there are pros and cons. Investing, there's no such thing as having dividend is better, not better, and so on. Now let me give you some specific example. If you are our graduate in our 4-day value investing program, you will know that there are 2 key instructors. One of them is me. Yeah. So I belong to the very US side. Yeah, I don't mind sharing with you that my portfolio consists of about 90% US listed company and about 10% SG company. And then the other instructor is my good friend. His name is called Liu Feng. His portfolio looks something like this: 100% all, how should I say, 100% companies that are all listed in SGX. Yeah, so I'll just put SG based company, SG, right? So in others, for Liu Feng, right? Okay, this is his name, Liu Feng, right? He's a full-time value investor. Yeah, so because he invested in companies that are listed in Singapore, and in Singapore, there are only 2 sources of income. One is capital gain. I just write it down, right? Capital appreciation. Yeah, capital appreciation. And the second one is dividends. Yeah, so because for Singapore-based company, there are only 2 sources of income. Yeah, if he didn't buy dividend-paying companies, I mean, let's exaggerate a bit. If all the companies inside his portfolio do not pay dividend, yeah, then he has to do his prayers that over time, right, the share price has to go up, assuming that he buy profitable companies. Because if he buy and he don't sell, that there isn't any cash, right? There isn't any cash, right? So previously, I think he did one research. He read one research. I think it's by this famous professor called Professor. I can't remember his name. But anyway, he did one research which shows that it's important for us to invest in companies that pay some form of dividends. Because over time, if you invest in dividend-paying companies, your return overall will surpass those people who buy non-dividend-paying companies. Yeah. So for him, right, it goes something like this. Yeah. So he has to buy dividend-paying companies because if not, only left with one source of income. Yeah. So that's Liu Feng's way of value investing in Singapore-based company. Now, so I'm here, right? I'm here. Now, when I buy 90% US-based company, I already know that I have to subject myself to 30% tax. And there is nothing much I can do about it. And because I knew beforehand that has to be the case, so my focus, right, has to be on capital appreciation. Because here is subject to 30% tax, right? So I have to focus on here. And because I have to focus on here, predominantly my portfolio consists of fast growth and medium growth. Now, so far in my portfolio, there isn't any slow growth. I cannot stand slow growth. They're just too slow. Yeah, and then if it's slow growth, US company, 30% withholding tax, it's just too much. So I only focus on fast growth and medium growth. I got 0 slow growth company in my portfolio. Yeah, so that's one thing, And because this dividend is 30% tax, I had to find an alternative replacement, right, of passive income. Yeah, I think fortunately US listed companies, allows investors like myself, including all graduates, to sell options. And because we sell something, we collect cash, right? We collect cash, and we can collect cash on a weekly basis or monthly basis. So this premium far supersedes that 30% tax that I've lost, inverted commas. Yeah, so overall I'm good. Yeah, overall I'm in quite good position. And the reason why I have 10% Singapore companies is partly because I was influenced by Liu Feng. Actually, I want to be 100%. But sometimes, he sit beside me and then he tell me this, tell me that. Then I was thinking, okay, maybe I should just buy some Singapore companies for fun. So it's a very easy, this 10% is just for fun. Yeah, most of my income come from 90%. Okay, huh? So if you look at this slide, you ask yourself, what kind of investors are you? Are you like Liu Feng, Singapore-based company focused on capital appreciation or dividend, right? Or are you like me? I'm okay to just, let go of this dividend and focus on growth and selling options. Now, both myself and Liu Feng are correct. We have two different styles of doing things, but both of us are still value investors. So what's common, right, between me and Liu Feng, right, is we are value investors, right? So in short, what do? We buy a good business at a really cheap price or undervalued price. Now, if you buy a good business at a cheap price and if it pays dividend, okay, it pays dividend. So if you buy a good business at a cheap price and if it doesn't pay dividend or low dividend, it doesn't pay. It doesn't really matter. So once we stick to this, we can either be like a Cayden way of value investing, right, or Liu Feng way of value investing. Yeah, but either way, at the end of the day, right, I just want to share with you whether you're investing in Singapore listed companies or US listed company, you can still generate three sources of income. A quick recap, capital appreciation, sometimes called capital gain, one source of income. Wendy say already, thumbs up, okay, thank you. The second one is you collect dividend. And of course, based on research, dividend pays company tend to be better for investors over time, right? So capital gain, dividend, and you're like me, you focus on US listed company, you have an extra source of income, right? Called selling options. And CFOS simply stands for cash flow option strategy. It's just our trademark for us to sell options. So right now we have three sources of income. Now, so here is quite broad. Yeah, because tonight is a YouTube live and we just want to, like over time, right, share with you certain bits and pieces of information so that you don't buy companies just because you hear something or high dividend and so on. So we must be educated. You have to ask yourself, if you don't generate these three sources of income, the GST has already increased from 7 to 8 on the 1st of Jan. Yeah, and then recently our Deputy Prime Minister say, hey, most people like to work. I do not know who are the most people that he's referring to, but I'm very sure that me and my colleagues, right, we all want to be financially free. I don't think we are the most that want to work forever. Yeah, so I'm not very sure what it's referring, but I'm just assuming that most of us, when we get older, we don't want to work for money. We should already have a portfolio of income generating assets that pays us for the rest of our life. Then we work because we choose to, not because we have to. So capital gain, dividend, CFOS. Okay, any other final things? If not, I'm just going to end in 10 seconds, right? Now, if not, I'm just going to end up with this slide. Yeah, so remember, I represent a VIA. VIA stands for Value Investing Academy. Our mission, right, is we care to make you a better investor via session like this YouTube Live or via our VIA Atlas US case study. So I wish all of you good health in this coming Chinese rabbit year, and most important thing, I want you to be happy, stay safe during this endemic year, and let all of us what right this year and beyond. Yeah, with that, thanks for joining us, and I shall see you in our next YouTube Live. So goodbye.